Major support for these programs is provided by Bank of America Merrill Lynch and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, New York's Window Company, GREENBERG TRAURIG, LLP, M&T Bank, Chase Commercial Term Lending. Additional support is provided by AVR Realty Company, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Bruce Mosler, Capital One Bank, Cassidy Turley, C.B. Richard Ellis, Chelsea Lighting, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Hal FETNER, DURST FETNER Residential, Friedman LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova Burns and Gian Tomasi, Investors Bank, James D. KUHN Real Estate Center at Syracuse University, Corman Communities, Madison Realty Capital, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Massey Knackle Realty Services, Meridian Capital Group, NEWMARK Knight Frank, Site Comply, Sterling and Sterling, SJP Properties, Stonehenge Partners, the WITKOFF Group, Urban American, and Ackman Ziff Real Estate, Ariel Property Advisors, Eastern Consolidated, Essex Capital Partners, Goldman Properties, Moynihan Group, Muss Development, RAL Development Services, the SPRANDREL Group, LLC, Rosewood Realty Group, Triangle Equities.
So here we are, it's 2012. 2011 was a great year for investment sales. But my Apple doesn't tell me what 2012 is, and I'm not the amazing Kreskin. So I have brought together 4 very intelligent investment sales executives to provide me their insight on the state of the market in 2012. My guests include Shimon Shakuri, who is the president and founder of Ariel Property Advisors, Ron Solars, who's managing partner at Brookfield Financial, J.D. Parker, who's a vice president and regional manager for Marcus & Millichap. And on the other side, another Israeli friend over here, Ofer Cohen, founder and president, Terra CRG. So, Shimon, how do you look at, how was 2011? Was it a good year?
I think so. By all counts, it was a pretty good year. I mean, in the multifamily market arena, at least, you've seen that transactions almost doubled, about $4.2 billion of transactions throughout the city, all 5 boroughs. Big, significant size of transactions were below 96, $2.5 billion, with some substantial core assets trading into institutions. You know, we felt that the reason for that was mostly because the fundamentals were very strong, and we felt that rents have been going up over the past 18 months consistently.
But I mean, have we seen rents go up to such a high level that have they reached the maximum? Can they go any higher? Ofer?
Well, I mean, we've seen 2011. We've really seen a remarkable comeback. Free market rents in Brooklyn, and my company focuses only on Brooklyn, so I'm going to focus on that. New construction free market rents in Brooklyn increased 10% year over year. And you have places like Williamsburg, waterfront fetching $50 a foot. You have places like downtown Brooklyn, $47, $48 a foot. And we don't see anything in the market that would stop that. We see shrinking inventory. All the inventory that's in the pipeline to be developed in Brooklyn right now is 2 years out. So in the next 2 years, while interest rates are still low, while there's a shrinking inventory, we don't think that that these rents I think these growth rates will sustain.
You think now, JD, prior to the show, you were saying that last year was good, but the first quarter of this year is going to be even better
It should be very strong. There was a slowdown in the fourth quarter last year. Last year there was about $25 billion in total transactions for the 5 boroughs, New York City. And I expect that to pick up significantly this year. I project probably a 20 to 30% growth factor in terms of total transaction velocity and dollar volume throughout the year. So there was a slowdown in the fourth quarter in terms of overall investment sales in the marketplace. I think a lot of people came to market last year that had been waiting in 2009, 2010 for the market to recover, and then took advantage of that strengthening that we saw across the market in all product types. Rents have certainly gone up. I think they're going to go up further. Very, very tight marketplace in terms of vacancy. It's the #1 market in the country in terms of vacancy, and it's very difficult to find a cheap apartment today.
So here's the question. 2000, as you said, 2011 was 25 billion or something on sales, and the interesting thing is no one really knows the true number, because you know Cushman and Wakefield and the others, they talk about sales over 10 billion. You know, you talk about in your statistics, multifamily, different numbers and all that. How do you look at it this year? Do you think companies will make a change or investors will sell if there's a change in the potential capital gains and ordinary income?
I would say that could be a motivating factor to sell today before capital gains goes up. To me, it's surprising that demand is so strong, but supply is so limited. And you would think with the environment of low interest rates and the potential increase in capital gains, you would think there would be more product in every category, for sale. And I think that clearly demand is helping to keep values very high.
I don't think it's going to be that significant. We've been talking about this projected capital gains increase for the last couple of years. There's certainly been a few sellers at the end of every year that get spooked by it and take advantage of it. But there's so many investors that are doing a 1031 exchange today that are just going to leave their money in real estate. So I don't think it's going to be a significant driving factor of why people sell today, but more they're going to take advantage of low interest rates.
Here's an interesting question. How many investors that you saw in 2011 and maybe in 2012 are new investors to the market? Because as one person has said, even in my office or something, he said, look, and there was a great article in the Times the other day about what banks give in interest rates and all the rest. There's no money. You get 0.002% for a money market account, and bonds aren't paying that. So there's better chance to take a risk reward in the real estate. So have we seen new people? Have we, I think you'll answer it. I still remember, it's like cycles. Going back a number of years ago, everybody wanted to be in the internet craze at the early 2000s. And then people wanted to be day traders. And, the conversation, I still remember one of my good friends said to me, should I buy distressed notes 2 years ago? I said, you're in the catering business. That's not your business. Okay, everybody goes, so who do we see buying today?
I think that in terms of new entrants to the market, definitely have them. And you see a few types. You see the guys who came, international capitalists coming in. We have experience with that on a building that we just put in contract on Central Park West. We have been experienced with that in terms of development that was sold to international developers that are actually going to put in operation here. We have experience with people that we've seen over the past 18 months looking for deals and investing through JVs with operating partners here. So these are new entrants to the market. But what's more interesting is that we see families that never purchased or didn't purchase in the past decade starting to buy. And operators that were more active in 2005 and 2006 stopped being active after 2008, coming back to market. And that's interesting to us.
JD, you see the same phenomenon?
Yeah, there's a lot of new entrants to the market. The vast majority of them are teaming up with a local experienced operator to make sure they don't make the wrong move. It's probably the #1 market in terms of regulation, city involvement, and dealing with tenants. It can be somewhat complex to a new entrant. So a lot of funds that we're seeing are coming in with an operating partner, maybe getting some experience and then looking to establish their own operating arm once they have that local knowledge that they've gained through their local operator. So I would say the vast majority of people buying right now are, you know, private client institutions that already have a strong presence, that didn't go crazy in the height of the market, and are very well capitalized to take advantage of some of the opportunities that they're seeing.
Ron?
You know, my firm is global, and we're seeing a tremendous amount of capital coming in. We have a partners meeting every Monday at 7:30 in the morning, where the 24 partners from around the world get on the phone and talk about buyers in their local markets like Germany or London or Brazil that have a strong interest in bringing capital here. So we're having a lot of those meetings. Last year, I was hired exclusively to sell a retail property on Columbus Avenue, and we went out to about 6,500 possible you know, buyers that might be interested. In the end, it was a bidding war between an Italian group and a Chinese group, and the Chinese group won the deal. And it's an opportunity for, you know, some of these groups like in Hong Kong that want to, because of the uncertainty back home, to bring some of their money here.
Since
to
I'm
New
older
York.
than you, my question is that money coming to the borough of Brooklyn?
It's interesting. What we're seeing in Brooklyn is actually two kinds of buyers. The first kind is the kind of buyer that was very aggressive during the distress days of the end of 2008, 2009, the beginning of 2010, and was able to actually buy real value. That value translated into wealth. Now they're using this wealth to buy more. On the other hand, you see all the people that saw these success stories. And keep in mind, in 2009, 2010, we didn't have success stories to tell. We only had failures. Now we're seeing all these people looking at the guy that tied up the best deal in Williamsburg, or the guy that managed to buy the best distressed note and turn it over and flip it.
But you know, you bring up an interesting subject. Of the major deals last year, most of them were recapitalization of note deals in Manhattan on the large deals. A lot of the institutions have sold their notes. I was with a large bank last week with their people in their workout department, and their comment to me was, we did such a good job, we may have worked ourselves out of a job. Do you see lenders still, and this is for all of you, I'm not posing it to Ofer or anyone, do you see banks and institutions continuing to sell distressed notes? That's one question. And the second question is, at par, what discount to par, and so on. JD?
We do a considerable amount of business in the region in that area. We represent a lot of local, regional, national banks in the marketplace. We don't see a lot of that in New York City. There's some in the boroughs, but it's significantly much higher in Long Island, parts of Westchester, upstate New York, and pretty heavy in pockets of New Jersey where there's been significant distress.
We've sold in the last 12 months only one note, which I think is basically telling the story. What happened?
So it's saying that the volume is down.
And it was over par. And we sold it over par after a bidding war. And I think most of the deals that we're seeing in the last 6 months are after the debt was already taken down. A new operator comes in, taking the debt, taking the deed, and repackage the deals and bring it to market.
So you're
seeing a lot of those.
You're seeing slower.
We're seeing special servicers bringing to market the small balance, mostly in the more distressed areas, certain areas of the South Bronx, and we actually just sold a package of 3 notes, 135 units in the South Bronx now, and on Pennsylvania Avenue in Brooklyn and East New York, which are the tougher parts of the city, and we see more of that coming to market through smaller special servicers. I think it's going to clean itself out throughout the year, but there's not a lot of it.
I do think the servicers are going to come more aggressively to the market with what they've been sitting on because, you know, every state's different in terms of their foreclosure laws, but the sense that I have right now with the servicers is that if there's anything left on the book and they didn't sell it, they're most likely going to clean it up in the next 12 to 20.
And the other thing is they've gained experience in dealing with these assets already. And so when we visit their offices with the evaluations and talk to them about what to do and what not to do, they already are prepped to, these are people that have been in the business for a few years now. These are not the new people that were hired, you know, 2 years ago and didn't really know how to act. So I think there's going to be more of that.
The thing I want to add is I've actually recently sold a number of notes for banks, and one deal that we just closed was in December, We had 2 notes tied to 6 properties in Washington Heights and Harlem, and we're actually really busy now talking to several banks about either selling notes subject to delivery of the deed, because obviously the lender is going to get a much higher value if they can figure out a way to deliver the deed. And in some cases, they already have REO where there's they're going to bring it to market. So I feel in the next few months, we're going to have several new deals from banks because they want to start maximizing value, and the market's
yeah, I'm hearing the same thing. I mean, we were marketing a package of notes, and the lender decided to take it off the market, go through with the foreclosure, and try to capitalize more value through selling of the actual title.
3-4 years ago, if somebody came to you or came to me and they said that they had a piece of vacant developable land, the banker or most people would say, good, live with it. The world has changed. 2011, we saw land in the High Line selling for close to $500 a developable foot. We've seen land in Brooklyn, selling for $100, $125, certain places. Do you see the continuation of this land, sale of land at a high price, coupled with the fact that we really don't have too many 421As unless you have the certificates ever? JD?
I see as long as construction financing continues to improve, which I think it will over the next 12 to 24 months, because lenders are back in that market and they're chasing yield. The borrower has to be very strong. But 2 years ago, it didn't matter how strong they were. You very difficult to get a construction loan. Today, that's not the case with a strong, qualified borrower with a strong balance sheet and a track record of experience. So,
but there's also a question which relates to this. I did a show 2 weeks ago on affordable housing, and every one of the panelists, including the banker who was here from Bank of America, basically said, we can't develop an affordable housing property if it costs us more than $30 a developable foot. The question comes in Manhattan, Brooklyn, Queens, New Jersey, and so on, Westchester. If prices go to a point that's crazy, there aren't that many people who land bank. How do you see that?
I don't really think it's crazy. Let's look at my favorite place in the world right now, Williamsburg. If you buy your land for $150, right? And even let's leave 421A aside because there's a solution for it for now. All right, so you buy your land for $150, and billing in Brooklyn is not like billing in Manhattan. So let's say your all-in cost, including soft, is $450 a foot, and your net effective rents, after your operating expenses are $42.
If you could build for $450 with a $150 cost, you're very lucky because there's a loss factor. There's
no $150 on the net. $150 on the net, $450 all in on the net, 40 net rents. You're at the yield of over 8 on your cost, and then you turn around and sell it to a REIT at 5.5.
I think the big driving factor is that
it's driving the market up.
Rents have gone up, and people can underwrite to that. There's very, very strong rental growth in the marketplace that people are forecasting and is tangible. So,
and what about condos?
Well, we have a development site in the east, in Midtown East, that we're seeing about $300 a foot, and that's going for condos. Most of the people are looking at that are international. Again, that comes with international capital to the most part, and they're also bringing international equity to build this. I don't think they're banking on getting debt. We have about 7 smaller sites in Upper Manhattan that will trade in the next few months. They're coming out of contracts as of last year. They'll trade between $65 to $80 a foot. The buyers are either, we have 2 sites that are going to be developed for affordable housing, small sites by affordable housing developer, 1 site by an international group that's going to be condos on 167th Street, another development site by a local developer who can get a loan, has done something, across the street from it, and a few people who land bank. And they land bank with some type of capital that we received from friends and family as a loan and convertible to equity. So we have all of that, and it's not necessarily developments for today. It's in the next 2 or 3 years.
I just want to maybe segment the market a little bit, at least what we're seeing in Brooklyn. Most of the sites that are trading are small sites that the local developer is building, and local developers have found ways in the last 3 years to develop the kind of product that is more efficient on the building, on the development end, but is more effective in terms of what the rents they can fetch. And most of the trades, I'm talking like 95% of the trades are 20,000 square feet, under 20,000 square feet. The upper market, the 50, 70, 80, 100,000 square feet sites are being driven by the REIT demand for that kind of institutional product. On the outskirts of that, you have these affordable housing sites that we sold a couple. Shimon is working on a couple. And we sold something for an 80-20 development for about $60 a foot. And we sold something 120,000 square feet buildable. We sold something 50,000 square feet buildable for about $54 a foot for affordable.
Okay, here, I've heard a lot on land. I've heard multifamily. I heard a little bit about retail. There are different asset classes. Are you seeing properties in the retail and the hospitality market being traded this much these days? I mean, in your spectrum, okay?
Small retail, yes. I mean, we're about to trade a building on 34th Street, which is a mixed-use building, and we're going to probably trade it at below 4.5 cap. We sold a retail condo up on 114 in Frederick Douglass late last year for close to $500 a foot. It was a brand new condo. We're in contract to sell.
What kind of tenant was the?
All local shops, and it showed an 8 cap with some projections, but still close to 450.
JD, what do you see on retail?
It's very strong. I mean, there's not a lot of pure freestanding retail, south of 96th Street. The mixed-use projects that we're under contract in the marketplace are pretty much all sub 4% cap rate on actual income south of 96th Street. Most of the retail rents that we see on stuff that we are marketing or projecting out, strong growth. People are underwriting to very strong retail growth. I mean, New York City is coming off of its best year ever in terms of tourism.
50 million,
50 million plus, and unless Europe has significant problems, it should remain pretty strong.
But, you do bring up the fact if Europe has problems. The euro, I mean, at the beginning of the year was $1.40 or $1.43. The euro is $1.29. A lot of our tourism is generated by the euros and by that going over there. And that tourism has a major effect in the hospitality industry, the retail industry, and the restaurant industry. So, that can have an effect on us.
It's something to keep an eye on. Certainly,
I'm not being the pessimist, but
no, it's a road bump. It's not a stop sign. Certainly with China coming on strong, you're seeing more tourists from that part of the world, from South America. I mean, New York City is the #1 destination for people to come to anywhere in the country.
So since my show is shown all over the world because of YouTube and iTunes and all the place, and if somebody would call any of the four of you and say, I have some money that I'd like to come and I'd like to park it. Where would you recommend and what kind of assets? Let's start with you.
I would say to them they should invest in what they understand. So, for example, if it's one thing to be passive equity, right? Maybe you invest with someone you trust, and the person you trust knows their specific. They always say invest in what you know. So if you're a guy from China and you understand multifamily, then if you come to New York, you probably should invest in multifamily. I like every category of real estate. You name it. I love every category, and I'm finding demand is strong for every single category. I think what's interesting is multifamily seems to have the lowest cap because it's considered the safest place to invest your money, right? In the worst of times, you still rent that apartment.
And as Ofer says, and JD said, the financing is there.
Yeah, I think for sure multifamily, and if I can add value-added multifamily, rent-stabilized buildings, not only the financeable at very low interest rates. I think that the loan-to-values today are just very low, and I think that it's an opportunity.
Before I let Ofer and JD give their comment, another way, and I did this a couple of months ago when I did a show, the easiest way for an investor to come into the real estate market is to invest into a good REIT that invests in New York City. You know, and we have some very good REITs, you know, who do invest into New York City in all asset classes. So, you know, that's another way.
I think it really depends on the culture. I think people coming to New York from different cultures have different levels of appetite for returns and for control. And, you know, it's funny, a couple months ago, actually in the summer, the largest for-sale housing developer in Japan came to our office because they felt that they want to be involved in development of housing, for-sale housing in Brooklyn. And so, you know, we're dealing with a lot of groups from Israel that their appetite for return and their sort of threshold for risk is greater, so they're investing in ground-up developments. And we're seeing Chinese on Hong. We just sold a building where the investor was from Hong Kong, and so it was a mixed-use building. They felt comfortable with a certain neighborhood, with a certain region.
JD?
It depends on you know, your timeline for holding and what your business strategy is. But you know, on the island of Manhattan, there is an unbelievable lack of supply. And so whether it's office building or investing through SL Green as a REIT or buying your own building and running that building, you know, rents over a 15 to 20 year horizon are going to rise on all asset classes, and they're not making any more land in Manhattan.
Okay, and I would like to allude, because, you know, you do talk, and I wrote an article which is coming out, you know, timing is everything, especially in life and in real estate. When Africa Israel bought the Clock Tower building and paid $200 million in 2007. It was a great building. When Africa Israel bought the New York Times building, no one really said that, but the Clock Tower, now to sell it for $165 million and hold it for a couple of years, that's a loss.
From my perspective, you know, anything that is cash flowing and either slightly positive or break even, I mean, if you can get sub 4% money in the market for 5, 7, or 10-year term, and you're going to buy at a 3.5 cap, but your rents are 50% below the market because they're stabilized or longer leases that are rolling. 45
seconds, quick. 2012 better than 2011 investment sales?
100% more velocity and stronger demand.
Ofer?
Absolutely. I think it's going to be
it sounds like I got the optimists. Shimon?
Yes, especially for the multifamily sector.
Mr.
I totally agree. We're very optimistic. We're feeling very good going into 2012.
So, you know, if I had to shine my apple, you're basically saying to me that with cheap money, large demand from investors, everybody realizing that there are less people buying homes as opposed to renting situations, you know, the outlook is bright for the investment market in 2012.
I agree.
Should be very strong this year.
Absolutely.
Okay, so I'd like to thank Shimon Shakuri, Ron Solars, J.D. Parker, and Ofer Cohn, and I'll see you next week.
Thank you.
Thank you.
Thank you.
So much.